Welcome to our webinar, everyone. How to Manage Your Banking Relationship and Not Be Managed by It by Tony Bush of Priora Cash Flow Management. My name is Ryan Kauth and I will be your host today. I direct the Wisconsin Small Business Development Center, or SBDC, at UW Green Bay. The Wisconsin SBDC at UW Green Bay is part of a statewide network and National America's SBDC network, supporting entrepreneurs and small business owners through no-cost, confidential business advising and targeted educational programs. Regional SBDC experts facilitate improvement and growth for small and emerging mid-sized companies and help launch successful new enterprises. The no-cost business planning and low-cost workforce leadership development training at the Wisconsin SBDC at UW Green Bay is funded in part through a cooperative agreement with the U.S. Small Business Administration, or SBA. Our website is uwgb.edu/SBDC. Today we continue our 2015 monthly no-cost 30-minute topical webinar series designed for the success of small business owners and their executive team members. At the conclusion of this webinar, we will share the upcoming webinar topics, and we encourage you to consider registering for those. We thank Mickey Noon and Chad Van Andel from First Business Bank for their partnership in promoting these monthly webinars and for their dedication to small business success. We also thank Michael Wentworth and his company TMR Associates, the B2B appointment setting company providing qualified leads and market insights. We thank them for their partnership in developing these webinars as well. After the webinar, you will be emailed a link to a recording of this webinar. During the webinar, you are invited to ask questions at any time. Please use the menu along the right side of your screen indicated here in the red circle. Type your question and hit enter, and as soon as I see it, I will make note of it for the presenter to address toward the end of our webinar. And now I'd like to turn it over to our expert presenter this month, Tony Bush of Priora Cash Flow Management. Tony.
Hello, Ryan. Thank you for the opportunity. Today we're going to be talking about how to manage your banking relationship. Don't be managed by it. It talks about establishing and maintaining a supportive and mutually beneficial relationship with your lender. We're going to walk through some of the fundamental points about what it takes to have that relationship and also how to manage it. Our next slide is a slide that illustrates various stars. And I open my presentation with this slide because it's important that the business owner understand when they approach the lending institution, they need to consider themselves a quality asset that the lender is going to lend money to, not be a customer. You're more than a customer. You have to believe that you're more than a customer. You're a quality asset. So basically this chart or this pictorial illustrates that the red line is the minimum standard of acceptable asset performance. Every bank has that minimum line. And if you get the loan, you're a green star. If during the course of the banking relationship, your green star drops below the red line and you become red, you have to fix it, become purple, and then back up again above the green line. If you can't fix it, they're going to ask you to leave the bank. The problem with that scenario is that all the banks in town, red lines are clustered together. So if you can't qualify for one bank's loan program, you may have great difficulty qualifying for another bank loan program. So what is the red line? Look at the second paragraph. Criteria that lenders use to measure the quality of their assets for the loans includes the leverage ratio, the debt coverage ratio, and liquidity, accounts receivable, accounts payable, inventory turnover ratios. That's called working capital, and the overall cash flow performance of the company. Now, one of the phenomenon about this chart is the higher your star, the better quality you are in terms of being an asset. The better quality asset you are, and the better you can negotiate the interest rates and the terms of your loan. In addition to that, more banks are going to want to bank you. So you have options. If this bank isn't serving you properly, you can go to another bank because your star is so very high on this chart. Our next slide is basically talking points. Don't be a customer at the bank. Be a quality asset. Choose your lender based on the sense of commitment that he or she shows to your business. It's a chemistry thing, not just an interest rate. Also, when you're dealing with your lender, be proactive with them. Don't surprise your lender. Good news is a nice surprise, but bad news isn't. So when things might be going bad for your business or you're in a downtrend of some kind, call your lender and let them know what's going on. They have as much interest in your success as you do because they do not want to have a non-performing asset on their books. Know the vital ratios that the lenders are using. We're going to go through those. We talked about them already, leverage ratio, debt coverage, and working capital. You should prepare a monthly budget, actual and month, each year. So your 12-month budget is prepared, and then each month during the year you compare how that month did to that budget, and that will be shown on both a monthly and year-to-date basis. It's a great benchmark for you to determine how your business is performing. Lenders have certain priorities they use to make loans. They make their decisions based on the character, capacity, and collateral. We'll go through those. Also, they make loans with the intention of making more quality loans, and then they would like to generate income from those loan relationships, and then they want to make a lot of those types of loans. But it's always in that order: quality, income, and then quantity. But we're going to talk about how do you approach a lender to ask for some financing. So the first point I'd like to make is that you need a good business plan, and your business plan has to be well prepared. As a former lender for almost 30 years, I liked it when people came with prepared business plans. So what is a prepared business plan? Essentially, 80% of it is a budget showing the monthly performance of the company for the next 12 months. And behind every line item in that budget for sales items and expenditures, you should write down why are you using those numbers in that budget. So for example, if wages in month 1 are 10,000, then they go to 11,000 and 14,000 and 20,000 and down to 14,000, down to 8,000. If it's varying by month during the year, explain what's going on. How many full-time equivalents do I have? How much overtime am I allowing for? How am I using part-time employees? Think about why you're using the numbers that you're using for every line item in your budget, sales or revenues plus expenditures, and write them down. That's 80% of your business plan. The next 20% is made up of a description of the business. What is your business? Who's your competition? Why is your business unique? A description of management. What is your management background in this business? How deep is management? Does it all just sit on your shoulders, or do you have some partners or spouses, family members, some really key employees who can keep the ball rolling if something should happen to you? Another 5% is the marketing plan. Of course, in the budget, you're going to have a marketing expense, but we want to know more about how you're going to market your company to your customers. Who is your customer? How are you going to beat the competition? Why do people want to come and do business with you? And then the last 5% is an executive summary. After you've completed the business plan and the first 5% categories, summarize it all in an executive summary, maybe no more than 2 or 3 paragraphs long. You want to review the budget monthly, comparing the budget to the actual. Don't surprise your lender. Your lender's a resource for your business. Next slide. So Benjamin Franklin asked, who's in control of this process? Or he said, basically, drive that business or it will drive thee. So who is in control of your business? It's you. You're the business owner. You believe in yourself, and you want to make it successful. Now, this is an interesting slide. It's from a page that a prior business system that I developed for business owners to budget, manage their cash flow, and also determine their break-even points. But this is just a snapshot of the budget page. It goes from January to the right off to December. The first 4 rows determine how much cash is available for each month. Then section 5, which is scrolled up under number 4, you don't see A through R because it's scrolled under there. But that's your total cash paid out on row 6, leaving us with an $81,000 cash position at the end of the month, which becomes your starting cash for next month. So your budget is made up of data that you have experienced in previous years, and you add to that data by what's happening at the end of the year for next year. Notice it also calculates your working capital position, your debt service coverage ratio, your leverage, your current ratio, and your quick ratio. The next slide is a breakdown that shows one monthly report. This is February, the second month of the year. And on the left side, again, you can see the 124 is the total cash available. Where'd the revenue come from? Here we have the complete list of expenditures, and then we have cash available at the end of the month, the cash position. Now, each one of the line items has a detail button or another tab button there, and that's where you go to write down the assumptions supporting why you're using that number. We'll see that in a moment. I'd like to point out a couple things about this very helpful page. You'll see 5 columns: the budget, the actual, the variances, the monthly impact over the remainder of the fiscal year column, and the annual budget. So let's take a look at purchases on row 5 alpha. We can see we budgeted $80,225 for the month. We came in at $81,000, that's our actual number. So we spent $775 more than we thought we would spend in the month of February. What does it look like after 2 months? Well, if you look at the year-to-date column in the budget column, you see we budgeted to spend $160,450. We came in at $162,000. We're $1,550 over budget. The impact of that variance, that year-to-date variance of $1,550, is that for each of the next 10 months, we have to make up $155. So we're taking the variance column, year-to-date variance column, and dividing that by the remaining number of months in the year. I believe that we can tell people, business owners, more meaningful information if we show them the dollar amount that they need to make up every month, rather than telling them that they're 1% ahead of budget or 3% behind budget. The other point I'd like to make on this page is if you look at row 7, the total in the budget column for the month is $141,000, and the actual for the month, we came in at $131,000, so the variance for the month is a negative $10,351. Where did that negative variance come from? Just go up that column, and every red number is what contributed to the $10,000. Now you can see from this chart that we came into the month with a negative $6,938. So we can't do too much about that history, but we could control purchases, we could control other expense, and also if you look at row Z, owner's withdrawal, they took out $3,000 more than they budgeted. So those red numbers really made up the full $10,000 shortfall. Finally on this page, if you look at the actual month cash balance on row 7, $131,176, that number should match what you reconcile for your checkbook that month. That's how you can check this figure to make sure that it's correct. So this is a very important page, and I hope that you can find a system that will help you understand the cash flow of your company like this page does. Right? This is the page where we talk about the written assumptions. Now on this page is the purchases, upper left corner, and we budget 17 items for purchases. Every one of those detail buttons has 17 rows. So we have the 12 months, and that's where we build our budget. And down in the assumptions box, that's where we explain why we're using the numbers we're using up above. We also use the assumptions box to explain significant differences between the actual, down below the next set of boxes. That's the actual number. So we build a budget up above all at one time. We go into the new year, and then as each month passes, we enter the actual data into each one of those months. Now, if one of those actual months should have a significant deviation from the budget, we can record why. We'll know it at that time. We don't want to forget about it because we want to be reminded of that next year. It may be a seasonal impact. This is a 50,000-foot look at the cash flow of the company between the balance sheet and the income statement. Our total assets are what generate the sales with employees and the equipment and the tools and everything we have. That's how we generate our revenues. The expenditures that we spend in our company are in support of those assets, and they also pay for liabilities that pay loans back to the bank. At the end of the day, we have a net profit. We can only do 3 things with a net profit. We can buy more assets, or we can pay off liabilities, or we can take an owner draw. So in this example, if we had a $20,000 profit, we could put $20,000 toward assets, $20,000 toward liabilities, or take it all out and have a nice vacation. But a smart business owner will maintain efficiency and balance in their company, and they might take that $20,000 and allocate it, some to assets, some to liabilities, and of course take the reward. That's why you're in business. The next slide explains the leverage ratio. The leverage ratio is a balance sheet ratio. You take your total debts on the balance sheet and divide it by the net worth of the company. In this example, we have $350,000 of total obligations, bank loans, accruals, long-term, current liabilities, everything. All debts, all obligations are $350,000 divided by the net worth of the company, leaves us with a ratio of 3.125. As you can see above, the maximum is usually 4 to 1. So you don't want to be over 4 to 1. The lower this ratio, the better. It demonstrates to the lender you have more skin in the game. It also demonstrates to you that if you only have debts of $350,000 rather than $400,000, then you have smaller payments to support the $350,000. You don't have to pay the larger payments that would be required to support the $400,000 debt. Leverage is very important. Our next ratio is the debt coverage ratio. We want to calculate how much cash have we generated, not profit, how much cash have we generated every month, every year to service the debt. We're looking at an annual cash flow here. So we have a net income for the year of $40,000. We have two columns here because I'm going to show you the impact of the balance sheet in a moment. So we take the $40,000 of net income, we add back depreciation expense because it's a non-cash expense. It's just a tax number, but we never really spent $20,000. And then we also add back the interest expense that we paid to the bank. We're going to take it out a little bit later, but for now we just add it back in. So if we add the income, the depreciation, the interest expense, we have total cash available for debt service coverage of $75,000. Now we have to look at our balance sheet. If receivables go up, that's a use of cash. If they go down, that's a source of cash. You've collected some cash. The same with inventory. If it goes up, it's a use of cash. If you sell inventory, a reduction of inventory, it's a source of cash. So for those on the accrual method of accounting, we can't forget the balance sheet. So on the first column, we had sources of cash of $20,000 coming in off the balance sheet. On the other column, we had uses of cash. We had growth in receivables, growth in inventory, and there are other things that would impact that as well, but those are two examples. So we have net cash available for debt service of $95,000 versus $60,000. Our annual debt service is $55,000, which includes principal and interest. So we're up above, we added interest in, now we're taking it out, and we have an excess or deficit of $40,000 or $5,000. So our debt service is 55. So 95 divided by 55 is 1.72. 60 divided by 55 is 1.09. Up above, you can see that you want to be equal to or greater than 1.2 times. The first column is more than enough. The second column is deficient. The balance sheet counts. Remember to look at your balance sheet. On our next slide, we're going to go through three quick working capital ratios. This first one is inventory turnover. They're all the same ratio. We're just using different numbers. So on the inventory turnover ratio, we want to calculate how much do we have in inventory and how long is it sitting there? What does it mean to us? So we take your annual cost of goods sold and divide by your average inventory. Note in the next sentence, you don't want to use the last month of the year inventory. You would add up the ending inventory for each of the 12 months and divide by 12 because you may have spikes and dips in your inventory. You want to average that out and get an average for the year because you're using an annual cost of goods sold number. So in this example, we have 98,000 divided by 14,760. We're turning our inventory over 6.64 times. The higher the better because it generates more cash flow for us. The average number of days that inventory will last, you take 365 days. I've got 360 that goes back to the pre-computer days in banking. If I take 365 divided by 6.64, we have 54 days of inventory. The longer this period is, the longer your cash is tied up. So if you want to be smart about this as a business owner, you want to follow the trends from year to year. Is 54 days, was it 58 days last year, 65 days the year before? Then you've got a positive trend. If it was 40 and then 48, now you're 54, things are slowing down for you. You should manage that. How does it compare to industry standards? I would mention here that you should check out your NAICS number, North American Industrial Classification System number online, and take it to your lender, and they will provide you with free. They should provide you free the pages from the RMA book that will show you per your NAICS number what your inventory turn should be for the size company you are. Also, you can ask what other the outstandings are and how do you improve it. The receivables turnover ratio, again, is the same formula. It's sales divided by average outstanding receivables. In this example, 175 divided by 47.5. We turn our receivables over 3.89 times a year. We're collecting our receivables every 92.5 days. The shorter this is, the better. Again, check out the trend. How do you compare to industry standards? What are you doing to improve your receivables? This is not you. This is you being a bank to your customers. You don't want to be a bank. Remember, an increase in receivables is a use of cash. A decrease in receivables is a source of cash. The next page is our accounts payable turnover, the third of the three. Again, same formula. We take annual cost of goods sold divided by the average outstanding accounts payable. Again, you add them all up, each monthly and year-end number or month-end number, add them up, divide by 12. In this case, it's $98,000 cost of goods sold divided by $16,275 average accounts payable. We're turning them over 5.86 times. We're basically paying our payables every 61 days. What is the trend? How does it compare to industry averages and so on? But I want to point something out. We were waiting 92 days to collect our receivables, and we find we're paying our payables in 61 days. We're upside down. So if you're not tracking these ratios, you will not know that you're bleeding those 30 days, and it's costing you precious cash in your company. So every day we get up and make decisions in our lives and in our business, and we want to keep our tuition as low as possible. Our objective is to keep our tuition as low as possible, and if we do make a mistake, learn from it. We need to make informed decisions, and we need to understand the cash flow of our company. And we don't understand the cash flow. We're only paying attention to it once a year. We got to pay attention to it at least monthly. I don't know of a successful company that does not pay attention to its cash flow weekly or daily. On the next slide, we're going to talk about debt consolidation. These are real numbers from a client I had a number of years ago, and these are 4 loans. You can see that the totals, they have $119,826 in remaining principal. The monthly payment is $3,486.33. If they take all 4 loans out to maturity, they're going to pay back $140,754. 2 ways to consolidate loans. The first way is the weighted interest rate only, option number 1. Same principal, 119. The weighted average interest rate is 8.23. If you do a quick calculation on those 4 actual rates up there, and you took an average, you're going to be over 9%. It's important to do a weighted average, and I'll explain that in a moment. The payment is $3,486, so we're going to pay all those loans off in 39 months. We're going to pay back $135,967. We're actually going to save $4,788 from the original 4 payments of $140,754. Another way to consolidate loans is to do the option number 2. We take the weighted average interest rate, and then we take a weighted average remaining number of payments. We have 48 months there, so we're solving for a new payment, which dropped about $500. So we're down to $29.38 a month. We're going to pay back $141,000, which is $285 more than the original 4 repayments up there, but we're saving over $500 a month for the next 14 months, which is the shortest remaining number of payments loan at the top. So $500 times 14 is about $7,000 a year in cash flow savings, although it cost us out of pocket $285 more than the original 4 loans, which is the best answer, the best option. It depends what works best for your company. Debt consolidation is key because debt is the biggest pressure point on the cash flow of a company. On the next slide, we're showing you just how to do the debt consolidation. I'm not going to walk through that. You can look at that later. And then next slide is when you're approaching your banker, they make loans based on character, capacity, collateral. They're going to judge your capabilities, your expertise, management depth. What is your personal credit score? How are you proactive? Do you make excuses? Is your place, when we visit your business, are people friendly, or do all the employees cower when you walk in the room? That's character. Character decides everything else in a company. So lenders are going to start with character. They also want to look at the capacity or the cash flow of the company. How much cash flow does the company generate to pay the loan back. We already talked about that ratio. That's how you want to pay the loan back, through cash flow. If cash flow cannot pay the loan back, the lender's going to look at collateral. What can they use to secure the loan and pay the loan back? That's repayment option number 2. The principles lenders use is they want to make quality loans, they want to make income from those loans, and they want to do a lot of them. The next slide is understanding your debt structure. Always use short-term debts to support short-term assets. Short-term is less than 12 months, up to 12 months or less. Long-term assets and long-term debts are more than 12 months. Examples of short-term assets are receivables, inventory, perhaps prepaid expenses. Long-term assets would be buildings and vehicles and equipment. A line of credit would be a short-term debt because it usually matures every 12 months. A term loan usually goes out more than 12 months, 7 years, 5 years, 20 years, depending on the purpose. Always take the longest amortization you can, but prepay the loan. It requires you to make a lower payment that month if your business hits a tough spot. And after you have a reserve equal to about 6 months of fixed costs in your balance sheet, if you've saved up cash that's equal to about 6 months of your fixed costs, then you start prepaying your loans. Why the 6 months fixed costs? Because if you hit a dead spot in your company, if you have a tough time for a few months, you have the cash reserves to cover those costs. What's included in fixed costs? Loan payments to the bank. So always try to save up a reserve before you begin to prepay your loans. The next slide is how do you approach your lender? When you're finished with your business plan, you walk into the bank, you make an appointment, introduce yourself, you go to 3 to 5 lenders, maybe 7 or 8 lenders, and you say, here's my business plan. When you review it, I would like you to make a proposal to me on how to finance my business plan. And don't say any more. Let the lender respond. When they've responded, you ask them, when can you be ready with a financing proposal? I'm a strong believer in who's going to do what and when, the WWW rule. So here you've established the lender is going to review your business plan, but you want to know when. So you must be prepared to personally guarantee your loan. Most banks and credit unions today will not do a loan to a business unless the owners are willing to guarantee it. That means you've got some skin in the game. When you are creating a business plan and taking it to lenders like just described in the previous slide, you're creating strategy among the lenders. You're creating a competition among them to compete for your business because your star is above that green line. You can defend your star. You know your business plan well enough. You believe in it, that you can be successful, and you want the lenders to know that. And let them know you're shopping it. The degree of success you enjoy with your banking relationship is directly related to how prepared you are when you present your business plan and how likely your plan is to succeed. You have to be able to answer the lender's questions and also hold them to their when. When they say they're going to do something, hold them to that, just like you're being held to when you commit to the lender. Then finally, our slide here, go back to the star chart. With the understanding of this presentation, I hope you were able to glean that it's important that you understand how your daily business decisions create the results that drive the leverage ratio, the debt coverage ratio, and the working capital ratios, because those are the 5 primary drivers of how a lender is going to underwrite your business loan request. The higher your star, the better quality asset you are, and the better you'll be able to negotiate with the lender, and you'll have other lenders competing for your business. It gives you great options, and when we have options like that, we usually sleep better at night.
Tony, I want to
thank you.
Yeah, go ahead. Sorry.
I just want to thank you for the opportunity to present today, and I hope it was helpful for you.
Tony, thanks again. I've seen a few of Tony's presentations, and I always glean something different. It's not that I'm not paying attention, but what he's talking about is obviously very important. There's lots of little nuggets really all over the place. So go back and view the presentation again when you're able. Tony, a couple of questions. One is, what if you have a current not so good relationship? What do you suggest with that?
I would recommend that if the business owner is having a difficult time in the relationship with the lender, go in and talk to the lender. and ask the lender to explain what the concerns are. Obviously, the concerns are not coming from that business owner, they're coming from the lender. Oftentimes, business owners can read things, or they'll feel innuendos, and it's like receiving emails. It's not a really efficient way to communicate. So you have to contact the lender and sit down with the lender, invite them out to your business, and just ask them to explain, what is your concern? Please articulate it for me. I want this to work like I know you want it to work. What can we do to make it work? I'll do what I have to do to make it work for both of us.
Thank you, Tony. The other question is more about online lenders than your traditional banks and credit unions, and about those types of relationships. Any opinion on that? You probably have kind of the same opinion I do.
Well, my opinion on online lenders or remote lenders from other states or other cities and so on is this. When we borrow money from a lending institution, whether it's in our community or elsewhere, we want to make sure that we have a good relationship with them. We have the opportunity to explain to that lender the strengths of our business. I've had business clients tell me, I'm dealing with one right now, where the lender made the loan based on the strength of the collateral, but the lender really wasn't interested in the cash flow of the company. The company's having difficulty. The lender never really underwrote the credit the way they responsibly should have done it, and now they're threatening to take away the collateral that the business owner offered as security for the loan. That's really a bad spot for a business owner to be in. And when I come across that situation in the beginning stages of that relationship, I tell the business owner, find a different lender, because the lender's only interested in a transaction. You're interested in a relationship. So we have a conflict between the lender's motive, transactions, fee income, loan growth, and the business owner's motive, relationship, partner, grow with me. The business lender should be in your community, be able to kick a tire, and the business owner should always be able to feel comfortable talking to the business lender, and the business lender should understand what's going on in the business, not just statistically and analytically, but understand what's in the business.
Thanks, Tony. It's like you said, that's a transaction, and this webinar and your goal should be a banking relationship, right? So,
yes, exactly.
Yeah, Tony, thank you very much. Again, great information. Very much appreciate you spending the time with us today.
You're very welcome, Ryan.
Our next webinar features Dick Dubois of Blind Spot, and he will present how your workflow improves your bottom line. Then in November, Jerry Baltus will present how to harvest maximum value from your business. And we'll end the year with our webinars in December with how to use benchmarking to increase your business value. You can register for our on-site workshops, virtual certificate programs, and all upcoming no-cost webinars at uwgb.edu/SBDC. We also have several past webinar recordings there on sales, marketing, business ownership, and leadership. In closing, I would very much like to thank Tony Bush of Prior Cash Flow Management. Tony, thank you again. Mickey and Chad at First Business Bank, and Michael Wentworth of TMR Associates. And thank you all for attending. Now you know how to manage your banking relationship. This concludes our webinar. Have a great day. Goodbye.